Well, and great to be joined right now by Peter Schiff, Chief Economist with Euro Pacific Asset Management. Peter, thanks for a few moments today.
Oh, my pleasure.
Obviously, lots of questions about kind of where the state of the U.S. economy is right now. Give us your overall view at this point.
Well, I think the U.S. economy is in a lot of trouble. I think we're poised for a unprecedented economic collapse based on the fact that the markets have prematurely celebrated the Fed's victory over inflation. The expectation is that the Fed is close to achieving its goal of putting the inflation genie back in the bottle, that we're going to be back to 2% inflation. And that means the Fed could slash interest rates back down to the super low rates that people on Wall Street have grown accustomed to, as well as the U.S. government and American consumers. But that's not reality. Reality is inflation is here to stay. It's about to take a huge move back up towards the year-over-year highs. We went from 9% down to 3%, but that was mainly because of a 50% drop in oil prices. Well, oil's up 40% in the last 4 months, headed much, much higher. And, the reason we were able to get the price down before was an unprecedented dump of oil from the Strategic Petroleum Reserve. Well, it's now at an all-time record low. We only have about a 20-day supply. There's really not much they can sell unless they want to deplete it completely. So now there's nothing to stop oil prices from heading well north of 100, maybe 150 to $200 a barrel over the next couple of years. And with that going on, I mean, inflation is not going anywhere near 2%. That means the Fed's got a lot more to do on rate hikes. And that means it's not a soft landing, it's a crash landing, and probably a worse financial crisis than 2008.
So let me start with the inflation component, because the Fed has obviously tried to target that 2% number for a while. And I think even the perception as inflation, the numbers have seemed to come down, is that getting from 4% to 2% was really going to be a tough pull to get to that point, correct?
Well, we're not even going to come close, because we're going to go back up.
Right.
Inflation is headed much higher, at least, the official measures. So they have no chance of getting to 2%. The markets just don't understand this. Now the Fed has to, try, which means rates are going to stay higher for longer, and nobody can afford it. If just look at the federal government, interest on the national debt is now the third biggest line item of the budget. It just passed national defense. But by the end of next year, it'll probably be the biggest. It'll probably be bigger than Medicare, which is number one. Imagine that. I mean, we're going to be spending over $2 trillion a year just in interest on the national debt. And the next recession is going to see annual budget deficits swell to probably $4 to $5 trillion a year, because we're running deficits right now in peacetime in a supposedly good economy in excess of $2 trillion. I mean, that's never happened before.
What should have or could have the Federal Reserve done to change the path of this?
Well, nothing really. I mean, if they would have done the right thing sooner, we would have had a collapse sooner. The problem was the Fed never should have bailed out the economy following the 2008 financial crisis the way that it did. It shouldn't have slashed interest rates to zero. It shouldn't have done all that quantitative easing. The Fed set the stage for the tragedy that's about to unfold. And there's no way that they can undo that, right? The mistakes were made a long time ago. Now we're just having to deal with the consequences.
So if we're going to see oil prices that high, you're talking about it just an unbelievable impact on the public in general as you move across the board.
Oh yeah, and not just oil prices. I mean, food prices. Right. Everything's going to go up, and so the inflation is just getting started. We're at the beginning. If you look back at the 1970s, we're like 1971, 1972. This is early days. It's going to get a lot worse.
What are your thoughts on the labor force right now?
Well, I think the labor force is going to be in a lot of trouble. I think a lot of people are in the labor force now with 2 or 3 jobs because they can't get by on one job because wages have not kept pace. with prices. I think we do have a lot of people that have left the labor force and they're just permanently, detached from it, living off of some type of government handout. And I think that's going to be a bigger problem. But also, I think there's a big skills mismatch. I think that American workers don't have the skills that American employers need. That's unfortunate. But that's a flaw in our educational system run by the U.S. government. So I think the labor force is in trouble. I think this next economic downturn is going to see a big increase in unemployment. A lot of these jobs are in the service sector, and we can't afford those jobs anymore. And meanwhile, you do have other things that are coming to help alleviate the need for labor. And as you have more onerous regulations, taxes, lawsuits, and things like that associated with being an employer, more and more employers are trying to figure out how they can organize their companies without actually hiring any people or hiring as few people as possible. So the government is unfortunately making it a lot more difficult for people who want jobs.
So let me put you in the big chair for a second and think about maybe the first couple of things that need to be addressed right out of the gate here to try at least start the path back in the right direction.
Well, I mean, we got to shrink government. I mean, that's the most important thing we can do is dramatically cut government spending, so we don't have these huge deficits anymore, because that's ultimately what's been driving the Fed and inflation is, the fiscal deficit. So they've got to go away. We need to see a lot of deregulation so that businesses are not hampered by all of that red tape, so that it's easier for businesses to survive and compete globally, without all that government regulation to have to overcome. But unfortunately, we're still going in the wrong direction. We're still increasing the size of government and a burden that it places on the economy and on businesses, and so we're just making the problem worse.
How about outside factors outside the U.S. and the potential impact that they may add into this mix as we move forward? Obviously, there's a lot of conversation around what's going on in China right now. The European economy has still got a lot of issues with it as well.
Yeah, well, right now, one of the best things the U.S. has got going for it is that other countries have problems too. And so the way the world has generally reacted to that is you buy the dollar as a safe haven, and that enables the U.S. economy to continue down this destructive path of consumption and debt. But now you're seeing a bit of a revolution around the world. A lot of the countries don't want to play this game anymore, especially after seeing what happened to Russia and how it got punished for using the dollar as a reserve. And so I think you're seeing this movement, particularly out of the emerging markets, the BRIC nations, to divest and de-dollarize. And that is going to be a huge problem for the U.S. going forward as the world makes progress in its move away from the dollar, because the dollar's role as the reserve currency is what our whole economy is based on. So we lose that and everything implodes, because our economy can't function unless we can get imports of goods that we don't produce, and unless we can rely on the world's savings to finance our debts. But if we can't do that, if we have to finance our own debts, if we have to produce our own goods, we're incapable of doing that.
Yeah. Sounds like the message also to investors would be kind of a concerning one as well as you move forward over the next 6, 12, 18 months.
Yeah, look, investors have to realize that everything that worked during the bubble isn't going to work as the air comes out. So people have to think outside the box. Don't take a cookie cutter, Wall Street approach to your investments. You got to prepare really, for a financial Armageddon, of stagflation, of a falling dollar, collapsing bond prices. I mean, just look at the bond market again today. I mean, this is a major, major bear market. I mean, don't underestimate how many more years this bear market is going to run and how high bond yields are going to rise. This is going to be probably the worst bond bear market in history. I think it'll end up being worse than the bear market of the 70s. And if you recall, interest rates, on treasuries ended that decade around 13, 14%.
Yeah.
And money market rates were up around, 20%, 21%, for a T-bill. So, where we are now, 5.25, in the short term, 4.25 on a 10-year or 30-year. I mean, we're just starting, even though it's already been ugly for anybody in bonds. It's going to get a lot worse. But people have to get out of not just U.S. bonds, but I think U.S. stocks are an accident waiting to happen. They're much too expensive. They're priced for, a fantasy of what's going to take place, where inflation comes back down. We don't have recession. It's like this Goldilocks economy where everything is awesome. Nothing's is awesome. Goldilocks, is going to get eaten by the big bad wolf here. So it's not going to turn out the way Wall Street believes. So what I advise people to do, and I've been advising this for a while now, it's not like I just started this approach, because I've been forecasting what's going to be happening for many, many years, because this has been a long time in the making. We're just now a lot closer to the reality of this. I didn't know that we could make it this long. We kicked the can down the road for a long, long time, but our ability to do that is running out. So you got to have a portfolio that is an inflation hedge. That means make sure you have gold and silver as part of your portfolio. Invest in the mining stocks, but also other companies, agriculture, energy, that will do well, with a inflationary environment where commodity prices are kind of leading the way higher. But also you need to own a lot of equities, but not the overpriced stuff that you find in the S&P or, the NASDAQ 100. You got to look around the world for value companies that you could buy at a low PE, that pay high dividends, that sell goods and services that their customers actually need and can't do without. And so as inflation pushes up the price of everything, they don't stop buying what you're selling. Maybe they'll buy a little less of it, but they're going to keep buying it. They're going to stop buying discretionary items. So that's not where you want to be. Or, you don't want to be selling things that the consumer can do without, because he's going to do without it, because he's got to eat. He needs to, heat his home or cool it or whatever. He doesn't want to be in the dark. So there are certain things that people are going to have to buy, and they're going to have to pay a lot more to buy them. So you want to own the companies that have pricing power, and not like, look what's happening now with all these cable companies, and other content. Consumers can't afford all these streaming services. They're broke. And so all these cable companies, content providers are feeling that, because they're losing their subscribers because they can't afford it. They need the money for food, right? So they don't have it. And so they're cutting back where they can. So you don't want to be invested in the companies that are going to, be on the losing end of that cutback. But I find the value internationally, and that's also a good hedge against the falling dollar. So, I'm building portfolios for people at Euro Pacific Asset Management that you can't really do yourself, and no mainstream Wall Street firm is going to do it for you. So if you're interested in protecting yourself from the inflation tax and kind of prospering during this, this economic period, I can help you. If you're more of a do-it-yourselfer, I've got 5 mutual funds that I own and manage, and you can buy these funds at any of the major brokerage firms or the discount firms. Some of the, the big full-service firms, won't let me on their platform. They just don't want the competition. But all the discount brokers, they have more of a level playing field, and they're not trying to guard their customer base from competitors.
Right.
But I've got an emerging market fund, which I think the emerging markets are going to do extremely well over the rest of this decade relative to the U.S. Got an international value fund, a dividend pairs fund, a gold fund, right, with all kinds of gold mining stocks, and I have a foreign bond fund. I mean, if you're going to be in bonds, you might as well be in short-term obligations of other countries, not the U.S. government, which is broke and is going to inflate away the value of its liabilities.
Peter, great to have you with us today. Thanks for your insight. We'll stay in touch. Thank you, sir.
All right, take care. My pleasure.
You got it. Peter Schiff, Chief Economist with Euro Pacific Asset Management.